Welcome to The Explainer. Today, we're diving headfirst into the volatile swings of the crypto market to see how we can actually look past the hype and the panic. We're going to do a holistic analysis of a specific asset to see what the real numbers tell us about avoiding emotional trading. Let's explore the data together, cut through all that noise, and lock in our focus.
So here's our roadmap. We'll start with the novice trader's trap, followed by our case study evaluating Polkadot. Then we'll unpack the 2026 modular war, look at some recent exploits and setbacks, analyze the technicals, and finally wrap up with the future of DOT.
All right, Section 1, the novice trader's trap. Before we can even think about analyzing complex blockchain architecture, we've got to address the psychological pitfalls that absolutely wreck beginners in volatile markets. Honestly, it's fascinating how universal these missteps are. Sourced directly from CoinMarketCap's analysis, there are 7 common trading mistakes to watch out for. First, that classic getting-rich-quick mentality. Then we have trading without a plan and using excessive position sizes, which, let's face it, is how you get wiped out. We also see forcing market reversals, basically assuming a trend has to turn around just because it's been going on for a while. Then there's copy trading, constantly switching your analytical systems instead of refining one. And finally, trying to trade sudden news drops. The absolutely crucial takeaway here, if you don't have a rigid data-backed system, your emotions will instantly cloud your judgment. It really all comes back to a core tenet we have to internalize. Crypto is not a get-rich-quick scheme. Don't invest what you can't afford to lose. I know, it sounds super basic, but ignoring this rule is exactly why so many portfolios are completely destroyed in a bear market. With this grounded mindset established, let's transition from basic trading theory straight into our real-world case study.
Section 2, Case Study, Evaluating Polkadot.
Is Polkadot dead? Look, if you spend literally any time on social media, you've heard this narrative. The asset suffered a brutal 90+% drop from its 2021 all-time highs. But remember those trading mistakes we just talked about? We absolutely cannot let the emotional market narrative of a dead chain dictate our strategy. We have to contrast that fear against rigorous, data-driven fundamental analysis. Just look at these 2026 health metrics for DOT. It's a tale of two extremes. On one hand, the network ranks number 6 globally with 98 active core developers over a 30-day period. That is massive builder activity, putting it ahead of giants like Cardano and Sui. Plus, there are over 65 active parachains. But check out the other side of the ledger. Ecosystem total value locked is only $40.5 million, and daily active users are sitting at just under 1,800. I mean, that is a surprisingly weak user footprint for such a robust developer base. But as analysts, we have to look at this objectively. Remind yourself not to make mistake number 6. Don't just abandon your analytical system because the price is down. Read the data. The builders are absolutely there, but the retail capital currently is not. Section 3. The 2026 Modular War. Now, to truly understand Polkadot's fundamental value, we have to zoom out and look at the broader industry architecture. This represents the major philosophical divide in the blockchain interoperability space right now. On one side, we have Polkadot operating as a modular monolith. It uses a shared security model through its new JAM upgrade, which acts as a trustless virtual machine alongside agile coretime, where developers buy compute resources dynamically. Basically, you plug in and you instantly inherit a multi-billion-dollar security umbrella. Pretty cool, right? On the other side, we have Cosmos representing pure modularity. Cosmos favors sovereign chains that connect via IBC and mesh security. In the Cosmos ecosystem, you govern yourself and you build your own validator set. Look, there is no strictly right or wrong approach here. It's just a structural trade-off. Polkadot offers institutional-grade pooled security, while Cosmos offers ultimate community sovereignty. Understanding this difference is exactly how you separate deep fundamental analysis from just staring at a price chart. Section 4. Exploits and setbacks. Because let's be real, no matter how solid the fundamentals or the architecture are, sudden, chaotic events will happen, and they will test your trading plan. Just look at the absolute whiplash of early 2026 here. On March 6th, the first U.S. spot DOT ETF launches, a massive institutional milestone. Then, on March 14th, a 2.1 billion token supply cap upgrade passes, finally fixing long-standing inflation issues. Things are looking incredibly bullish. But then, April 2026 hits and disaster strikes with a massive hyperbridge exploit. Seeing this timeline, you can understand exactly why trading mistake number 7, trying to trade the news, is so incredibly dangerous. A fundamentally amazing month can literally be upended in a single afternoon. The severity of that exploit really cannot be overstated. Hackers forged messages and somehow managed to mint 1 billion fake DOT tokens on the Ethereum network. 1 billion. They immediately dumped these tokens onto the market. Now, while the actual monetary value extracted was around $237,000, the psychological damage was catastrophic. The sudden influx of synthetic supply triggered a massive wave of retail panic selling, dropping the price by over 5% in a single day and completely overshadowing all of the network's positive governance upgrades. Section 5, Analyzing the Technicals. So, we've looked at the underlying fundamentals and we've analyzed the breaking news. Now let's see how all this builds our technical understanding with a really crucial concept: RSI divergence. This occurs when the price of an asset hits lower lows, but the relative strength index, which is a momentum oscillator, makes higher lows. It indicates a potential weakening of the downward momentum. But hey, remember trading mistake number 4? Just because you spot an RSI divergence and momentum is weakening, it does not mean the market has to reverse immediately. It's a signal, folks, not a guarantee. And here is the stark reality of the chart right now. DOT is sitting right below its short-term 20-day exponential moving average resistance at $1.27. It's clinging desperately to critical support at $1.20. And honestly, we're seeing entirely conflicting outlooks across the board. The bulls are pointing to higher time-frame descending triangles, targeting a massive $10 breakout recovery. The bears, on the other hand, are pointing at the lack of trading volume and broader altcoin weakness, warning of a breakdown to $1.05 or even lower. Remember, our job isn't to blindly guess. Our job is to watch these specific levels: $1.27 on the upside, $1.20 on the downside, and wait for real volume confirmation. Finally, Section 6, the future of DOT. Let's look past the current daily volatility for a second and examine the long-term structural changes that are really going to dictate this asset's ultimate trajectory. We are looking at a dramatic economic shift. Through a massive governance proposal called Wish for Change, Polkadot fundamentally altered its tokenomics. Annual token inflation actually dropped from roughly 7.2% down to about 3.1%, and they implemented that hard cap of 2.1 billion tokens. This essentially creates a Bitcoin-like scarcity model for DOT, slashing the constant sell pressure that has suppressed the price for years. Structurally speaking, the asset is tighter than it has ever been. So I want to leave you with this provocative question to synthesize everything we just covered today. If an asset has top-tier developer activity, brilliant architectural upgrades, and a newly scarce tokenomics model, but still suffers from devastating price action and low retail usage, which metric tells the true story? Are the charts just lagging behind the fundamentals, or are the fundamentals failing to attract real-world demand? By combining the psychology, the fundamentals, the news, and the technicals, you now have the exact framework to answer that question for yourself, without ever letting your emotions take the wheel. Keep analyzing the data, keep refining your system, and never stop learning.